Welcome to our November 2023 Special Needs Chapter meeting for the NADP. And today we have two of our very own members as our TED Talk presenters. Isabelle Grard is a Chartered Special Needs Consultant, Chartered Retirement Planning Counselor, and Accredited Wealth Management Advisor, and franchise owner of Ameriprise Financial Services. And Ian Kansky is a Certified Exit Planner and Financial Advisor at Strategies for Wealth, serving business owners, special needs families, and high net worth individuals. So welcome, and we look forward to your presentation.
Thank you. So Ian, can you share the slides?
Yeah.
Perfect.
There we go.
Okay.
Do you want me to start? But you start and share.
Okay.
Yeah.
I will start then, and we can go on to the next one. I guess the next slide. These are our names.
Okay.
So this is basically, we wanted to start from the very basic, because life insurance is complex. It's and not everybody is a specialist. So let's go back. We thought we would go back to the basics. So what types of life insurance coverage can we get? If you decide, okay, I want life insurance, I want to cover my life or someone else's life, what are my choices there? So to go to the basic, we have two main types of insurance. So you have the temporary type, and then you have the permanent. So the temporary in the left side, and the permanent as in a whole life and universal life. So we have to think about, if we consider for a minute just the temporary life insurance coverage, we can think about it as if you're renting your home, right? You pay a rent for an amount of years, which could be, 10, 15, 20, 30 years. So you pay a rent, you don't own anything, but you pay just like your rent on your apartment or whatever. The permanent side is like you're buying your home. So you are paying month after month or whatever it may be, but you are building equity also, just like you're doing in your home. So term insurance, renting, you rent for, let's say, 15 years, you're paying for 15 years, and 15 years plus 1 day, your coverage stops. That's it. But if something happens to you or to the person covered within those 15 years, there is the death benefit that is, coming into place here. But after that 10, 15, 20 years, the contract is over. You do have some renewal options on some of those terms, meaning that after 10 years or 15 years, you could have a renewal, but you have to see it as the renewal very expensive, because first it will be based on the age you reach, and then it will have some new requirement as far as health testings and all that. So term in general, very cheap to rent. Permanent, as in whole life and universal life, more involved, more money in it, but more opportunities. It's like buying, you're building your equity also. Ian will discuss those two more in depth in our next slide. We also will talk about the role that both of them have in our lives, in our lifestyle, in our plan, and in our special need planning in particular. Anything you wanted to add, Ian, on this, or we can go to the next slide?
No, I think we'll just go to the next slide. I think you did an excellent job sharing that. Yeah. All right. Go forward. Click here and then go forward. Okay. So Yeah, right. Computer logistics, got to do that on top of the presentation.
I know.
So what I find is that we talk a lot about the estate plan and putting together a special needs trust. And then the funding question kind of goes out the window and nobody really talks about it. Like, how are we going to get money into the special needs trust and also balance lifestyle today for something that we're planning on in the future? And life insurance becomes a really big part of that. Choosing the correct type of life insurance for your situation then becomes imperative. The big problem with life insurance is that once you put it in place, redoing it is difficult, especially 5 to 10 years down the road when all of a sudden you discover that their health is no longer what it was, or that the new cost has become just prohibitive and we can't make that happen. So some combination of term and permanent is usually ideal. And that term and permanent insurance should come from a mutual company. So we'll talk about that on the next slide. So I wanted to list some pros and cons. Because for a family with special needs members, universal life is not appropriate. I'm just going to go out and say it. It's quasi-permanent. It's not really permanent insurance. It's more like two products in one. It's yearly renewable term, which means that the internal cost of your policy is becoming more and more expensive every year, and an investment account. So if your investment account goes down, however, the cost of your insurance is going up, that means that the cash value in your policy or the cash surrender value will be going down. And when that value reaches zero, two things will happen. Either they are going to ask you, the life insurance company is going to ask you for a check to make up the difference, or your policy is going to lapse. And the last thing that a special needs family needs to manage, in addition to all the other things that you're managing, schools, transportation, family events, is managing your life insurance versus buying whole life. Whole life insurance, after a certain period of time, can take on a life of its own, where the dividends and interest will be substantial enough to pay for the premium. So we do recommend that you pay for it for life, right? Like everything else, if you insure your house for as long as you're in there, as long as you have your car, you insure it. So as long as you're alive, we should insure your life. So I wanted to come right out and list the pros and cons. And as you can see on the left with the permanent insurance, there's quite a list of the word guaranteed. And as you see on the right, there is no word guaranteed. Actually, the word risk shows up quite a bit. So what are we guaranteed with whole life insurance? We're guaranteed a death benefit. We're guaranteed mortality coverage, which means that if the life insurance company is insuring people who have crappy health, and it costs them more, well, the insurance company has guaranteed your costs and they will not pass that on to you. They guarantee the expenses of your coverage, same line of thinking around the cost of mortality is the cost of running the insurance company. So those are guaranteed, they don't pass that on to you. Cash value is guaranteed never to go down, guaranteed to have a death benefit, and it's guaranteed to be participating in a mutual company, which means that every policyholder in a mutual company is also an owner of the life insurance company. And when the life insurance company pays dividends and interest, it doesn't go to the stockholders, it goes to the policyholders, because the policyholders are the ones that own the business or own the company. So I wanted to see if we can share another diagram with that. So I'm gonna, another way to look at it. So I'm just gonna share something out of living balance sheet that we use to describe this. And I have to make sure I choose the right screen. You know what, I'm just gonna stop sharing this and share something else. Share screen. Come on, exit. And it was just easier to get rid of that, do this. Yeah. I think this is a nice way to look at it. So if we take a look at life insurance in its truest form, right, it's yearly renewable term. So every year you get a little older, the life insurance becomes a little bit more expensive. And you pay for a level death benefit. So what happens is you buy it today, right? We start today, becomes a little bit more expensive each year, and the death benefit remains constant. Now, the life insurance company will offer to you a 10-year, 15-year 20-year and 30-year increments, but basically all they did was spread out the cost. But in its truest form, this is the way life insurance really is. Any questions around that? And then there's whole life. So whole life comes with a consistent cost. It never changes. It's actually guaranteed in contract to remain this level. Now, like Isabelle was saying before, when you buy whole life insurance, it's like buying a home. And typically our home will appreciate in value. Well, your life insurance, when you have whole life, will also appreciate in value, which means that the death benefit is actually growing. So when you purchase a death benefit of $500,000 in 10, 15, 20 years from now, it could be $1 million. While you're paying into the policy, your cash value is growing. Now, I want to point out this little section here. And this is why people call whole life insurance expensive. Because when you start out paying for whole life insurance, there is no cash value in your policy. So much like when you buy your home and you go for closing costs, there's no equity in your home. However, over time, as you start to pay down your mortgage, the equity in your home begins to grow. Very similarly here, as you pay into your life insurance policy, your value of death benefit is growing, and so is your cash value. And then at some point along this line, there'll be enough dividends and interest to pay for the life insurance on its own. So if you choose not to pay for it any longer, it will continue to exist. And it will continue to exist for your entire life. Conversely, what does universal life look like? So universal life has a stable death benefit. The death benefit really does not grow. It's not guaranteed to grow. There's no language in the contract that says your death benefit will grow. However, if by some chance your investment account grows substantially or it outpaces the cost of the insurance, then it is possible that it may grow. But as you see, as I mentioned before, inside the policy is yearly renewable term. So this same cost line that we saw with the term is in universal life. Now, what I find interesting is that instead of it being cash value, it's actually cash surrender value. And I'll draw your attention to the difference between the two lines. People like universal life because day one, when you put money into it, there's cash value, and that looks great. And then they say to you, okay, now the investment account's going to grow, and it looks great until you're like 75 or 80, and the internal cost of the policy becomes very expensive. So where do they get the money from to pay the policy? Well, they take it from your cost surrender value. And as you can see, it starts to go down. And at some point when this goes down, when you're 80 years old and it reaches zero, you're either going to get asked for a check for $50,000 to $100,000 to keep it in force, or you're going to let it lapse. So you would have paid $300,000 for a policy that no longer exists, and now you have no way to fund your special needs trust. And that is the reason that this is not a good policy for special needs funding. When you need it most, it may not be there, and that is a problem. I'm just going to share two more things with you.
Can I just
go ahead, Isabelle. I'm sorry.
One thing, I just want to remind everybody, when you pay and again, I'm going back to basics here. When you pay a premium to the insurance company, in a case of let's say not the term, but let's look at whole or universal life, you have a portion of that premium. Let's say you pay $200 a month for that policy. A portion of it goes to the pure insurance cost, right? And that cost will rise every year. That's what Ian is explaining with the cost, the renewal cost every year, because every year we are getting older and the cost of insurance, the basic pure cost of insurance increases. Then a portion of that premium goes to all the admin fees that those companies have, which is, standard, I'm going to say. And then you have the portion of the premium that goes towards the investment account. Okay. So as you are younger, more portion of the premium goes to the investment account, which is what Ian is saying. Now your universal life, when you open it, it looks great because the cash value of it is there, right? because a bigger portion of your premium goes towards the investment portion. But as you get older, as we get to that top of the curve here, the blue curve, your cost of insurance and all that goes higher. So they are going to have to take it from somewhere. So in the investment portion will help pay for the underlying cost of insurance. So there's a lot of things going on there that we don't see, which is why, to Ian's point, whole life has more guarantees and is more appropriate to special needs. Thank you, Ian. You
You're welcome.
can,
So
you have nice slides here.
graph. So how important is life insurance? And this is really, where the rubber meets the road. Like, why do we talk about life insurance so intensely? So when we buy term life, we get a few things, right? So we have the protection part, the cash part, right? The liabilities. Like, this is our house, right? Think of the protection as the roof, and then the assets and liabilities are stuff we put in our house, and then our cash flow is our foundation, right? Our cash flow is what makes our life go. If our cash flow goes to zero, then, everything's out the window, and we're just trying to figure out how to deal with cash flow. And then we may run to the bank and say, okay, let's buy a CD. And we get all these nice things with a CD, which is awesome, but we don't get any protection at all. So if we die or become disabled, there's no self-completing of your plan. If you have 100,000 in a CD, you have 100,000 in a CD. So it's like, okay, how do we get some return on our investment? And a bond fund might look great also, but there's absolutely no protection. You get the point here, right? So mutual funds, right? What are we getting with a mutual fund? Just basically what we put into it. And I'm not saying that investing in the market is a bad thing in any way, shape, or form. But when it comes to special needs planning, where am I going to put my money first? How do I make $1 work as hard as it can for me? I do like that the 401k provides lawsuit protection. That life insurance and your IRA are protected against creditors. So if you get sued, you can't get sued for your 401k or your life insurance typically, or your IRAs, which is awesome. However, how do we get all of the boxes? Only permanent life insurance, whole life insurance with a mutual company will cover everything. So when we put together a financial plan, quite honestly, special needs or not, life insurance with life insurance with a mutual company needs to be your first step. And we'll just finish up with the slide. Any questions
Oh,
on that?
Can you go back to the term life? I wanted to take a picture of that also.
That's
Oh,
a
yeah.
great, that is a great.
It is such a good visual.
I had never seen that. That's very good. Yeah.
Thank you.
You're welcome. So like Isabelle was saying, from a basic standpoint, without being too much in the weeds, because really using a professional to help you purchase your life insurance is super important. There's so much more that goes into it than we're sharing here. But if you're going to work with somebody other than Isabelle and myself, these are the things that we need to keep in mind. First of all, you want to buy your life insurance from a mutual company. So that would be Guardian, Mass, Northwestern, Penn Mutual, Minnesota Life, National Life, like somebody who offers mutual life benefits. Some combination of term and whole life is great because it helps us allow for a higher death benefit while maintaining cash flow for lifestyle, right? We want to make sure we have lifestyle today. We don't want to be saving every dime we have for some future event and then not being able to go out to dinner and stuff. Like that's just like ridiculous. But there's zero, which is unacceptable. And then there's the moon and the stars, which, most, probably can't reach. But in the middle, there is something that's right for everybody. Universal life is quasi-permanent. I will only present universal life if somebody realizes that they're going to gamble on how long they're going to live. It is strictly a gamble on mortality. How much do we need is a big question, right? How much should I buy? Well, life insurance is about human economic value. You can't replace a mom and you can't replace a dad. But what we can do is we can replace you economically. So basically, your salary times number of years to retirement is the maximum amount an insurance company will allow you to be insured for. And we call that human economic value. So we want to get as close to that number as possible while also keeping budget and cash flow in mind. Then life insurance comes with some really cool add-ons, like long-term care. How great is it to pay $1 and have life insurance and your long-term care taken care of together? Now, if you do need long-term care and you take it from the policy, it will reduce the death benefit. However, you will not be spending all of your assets. So you may have put, I don't know, let's say $100,000 into your life insurance, which has now generated $400,000 of long-term care while you're maintaining all of your other assets. Life insurance can generate tax-free income, like a Roth. However, for people who make too much money, they may not be able to buy a Roth, and Roths do not come with death benefits. Life insurance is the rich man's Roth. The IRS discriminates against wealthy people. Life insurance is how they overcome it. And then college savings. College savings in life insurance is ideal because in a 529, I'm just going to tell you, 529 is the worst product that was ever developed, in my opinion. When you put money into life insurance for college savings, if you pass away unexpectedly, your child still goes to college and you get to keep the house. If you pass away with your money in a 529, whatever's in the 529 is what they get. Also, if your child is wicked smart and they wind up with a scholarship, now you're trying to figure out how to pay the taxes to get the money out of the 529. Oh yeah, and also the 529 affects your expected family contribution, which they've actually changed the name of that now. It's called SIT or something else. And the more money you have in a 529, the less money FAFSA is going to lend you. So if your child's going to be a doctor and work for a hospital, you want to borrow as much money as you can because there's public service loan forgiveness and get your education paid for by the government. Just as an aside, my daughter is a doctor of audiology. She works for the VA of Miami. Her student loans, we paid for undergraduate, which now as I look back on it was a big mistake, but she has $180,000 of student loans for her doctorate. Now, during COVID, they were giving credit for people, they were giving credit to students as if they had paid. So my daughter has 40 payment credits, never having had paid a single day in her life. So she's just started. She'll pay for the next 80 months, like 30 grand, and the rest of her loans will be forgiven tax-free. So this is where life insurance becomes important because if I took the money out of the life insurance policy and she didn't need to use it, I could put it back. Or we never had to take it out in the first place. With 529, we have to move it around. So life insurance becomes multifaceted. It's not just special needs planning. It can be also used for all kinds of other things. So I just kind of wanted this to be a simpler way to say, okay, what criteria do I look for when I buy life insurance? And this would be the basics. Anything to add, Isabelle?
No, I just wanted to get back to a point I hear all the time, or not all the time, but I've heard it for, let's say, a family and the man works and the wife stays home and takes care of the kids. We should only buy insurance on the father because we need to replace his income in case something happens to him. But this is not right. The home, the mother at home is doing such a work for the family, taking care of the kids, that we need to replace. If anything was to happen to her, the father would now have to go get child care. He would have to get somebody to clean, maybe cook or do whatever it is that the mother, the wife at home does. So there is a necessity for coverage for both the father who works in a situation where one works, the other one stays home. So I just wanted to point that out too. That's something I hear a lot. Or my wife, we don't need to replace her income. Well, think about it as you lose your wife tomorrow, your kids still need to eat, they still need to be taken care of, they still need to be watched, so you'd have to replace that income also, that hidden income, I guess you call it.
So along those lines, second to die is not appropriate. You hear this all the time. Oh, I'm going to buy second to die. Second to die would only be appropriate if both parents are already insured on their own. We don't want to have a second to die policy where one dies and the other one gets nothing. It's a disaster area. However, I do find that some people are buying second to die policies on their parents, which is great. And if your parents are open to it, it's an awesome way for them to help fund a special needs trust, right? But if it's just you and your husband, or you and a spouse, or just you each need to have your own and then consider a second to die. And I know that it is a little bit more expensive or requires more cash flow to have two, but two is definitely ideal. I do not ever recommend having second to die without each having their own first.
Yeah, I agree with that. Any questions from anybody, maybe?
Yeah.
Or we hope that it's pretty simple. I mean, it's very complex, right? So that's, yeah, Marianne, did you have a question?
Yes, I had a couple questions. One is about the beneficiary. So, if you're married, husband or wife, right? But if you're divorced, I understand it goes to the third party trust, right, for that child. Is that right? And then if so, then how is the parent, or I guess maybe it depends how the trust is set up, going to use those funds to take care of the child?
So Ian, you want to?
Yeah, so I want to see if I understand the question correctly. So buy a life insurance policy and the beneficiary is the third party trust. And then how do we manage the money in the trust? Is that the question? Or
so first of all, so I'll make sure that's the correct way, or can a divorced couple or ex-couple have each other's beneficiary, or should it go to the child's trust? What's the better?
Oh, got it. Okay, so beneficiaries are, of course, based on each situation. However, I do recommend that each parent names the other one as beneficiary first. And then we can change beneficiaries later for the trust. Or you can do contingency, right? So first mom or dad is beneficiary, and then we can, if both of them have passed or predeceased, then there's a conditionary beneficiary that will go to the trust. But or you can split it all up.
Yeah.
Right,
Yes,
so you can split it.
Some situations in family would not allow that to happen.
Yeah,
right.
in a divorce situation, I think.
Yeah, like a
You have
divorce
to be
situation,
careful.
that would be.
Right, so for each situation, it can be set up so that it fits the general. Now, some divorced couples get along really well and they're all about, where it's supposed to be, and we can do it one way. If they don't get along, then it's going in directly into the trust, and this is where you want it to handle, and then that trustee is going to handle it. And then managing the trust then is a whole nother conversation. But just so you know, it's super flexible. And quite honestly, you can log on and change them on a daily basis. It's so easy to change beneficiary that if you have a fight with somebody and today you're pissed, and this has happened with some of my clients, they have done that. And then I had one getting divorced and he was pissed and he changed all his beneficiaries. And then his attorney was like, you can't do that. And the next day he logged on and put it all back, right? So it's super easy to change them and it's flexible. So if your plan changes along the way, then you can update beneficiaries. So what I like to say is that the plan is sturdy, yet flexible. Did I answer your question?
Yeah, thank you. And another question real quick, if no one else has some, I'll keep it brief, is, so you mentioned universal life, that it may run out and then the premiums may increase, right? Or just not have a benefit. So I guess I'm trying to understand, why is that advantageous over a term policy if you're going to end up with the same end result where there's no money left?
So think of universal life as a permanent term, right? So it's term as long as you're paying for it. So the problem, however, is that if the investment account doesn't keep up, the amount that you may have to pay for it in your 80s could be like $75,000 or $100,000 a year, and you'll be like, oh, you know, this is just not happening. So it is permanent as long as you pay for it. With the whole life, it is permanent as long as you pay for it. However, the internal workings of the policy remain level and lower. So therefore, the internal workings of the policy can pay for itself. So if you can't pay for it, it will continue to exist. So permanent term versus actual whole life insurance. So it's not that it's
right.
Those products. I'm sorry. Products are not inherently good or bad, right? Will they fulfill the strategy that you're looking to accomplish? So I don't want to say it's good or bad. It's just that I find that most folks will not accomplish their goal by utilizing universal life.
Yeah. Any other question? Good questions. Nope. I guess so. I guess the bottom line is
build your bucket.
Yeah. The bottom line is that's where working with a professional is very important, and it's goal-based, right? You have to start with what you need to accomplish and then make those policies work. A mix of term and permanent insurance is very often the solution. I agree with Ian, universal has a lot less guarantees and is more of a gamble. But both term and whole life would be a good combination. But again, it starts with your goals. But like you said, Ian, I like that the plan is sturdy, yet it is flexible. That's a very good way to summarize the whole thing.
I had a question. I'm sorry, Emily. Do you want to go first? Okay. A question. You mentioned how for it could be advantageous to have the same company so that down the road they could potentially pay the long-term care bills. If I have like Mass Mutual for long-term care and for whole life and for term life, but I happen to have different agents, can that still happen because it's the same company, or they're not overly connected?
So if you already have a life insurance with one whatever company and then a different long-term care insurance, it's two different products, right? You have life insurance, then you have the traditional long-term care where you pay your premium and it's pure long-term care benefit. And then you have those new hybrid products also that do life insurance and long-term care. So if you die, you use the death benefit, but you don't, and you need long-term care benefit, you use the same policy. And then you have a fourth option, which is the life insurance with a long-term care rider. A rider is an option that you put on top on your life insurance contract. So if you have a life insurance, I don't know the answer to that, Ian, but I presume that you cannot add your rider once you have, or at least that's my experience.
No, that's correct.
You cannot add a rider for long-term care on an existing life insurance policy. You'd have to reissue a life insurance with a long-term care rider, or go for those hybrid products, which I really, really like, actually. You put $100,000 premium if you have like a little money aside, and then you get that $150,000 or whatever of death benefit, but you also get $300,000 of long-term care benefits. So that's a whole different product. So if you have life insurance, you cannot add to it once it's already issued. That's the bottom line on your question. Does that answer your question, Susan?
Yes, thank you. I appreciate those different options. I'll have to ask the agents to know what I specifically have. Thank you.
So I'm sorry, Emily. To finish up, Susan, I guess if all your agents work for the same mutual company, you still have that one company. So I guess they can all do the same thing, I guess. Sorry, Emily, sorry. Go ahead.
My question may be a very dumb one, so
There's no such thing.
Judgment-free zone.
Yeah. But as I'm starting to expand and work with people in other states, is it critical that you're talking with an agent? So I'm thinking about, I've already have people in mind. I'm like, oh, who, in mediation, this is a huge issue, and people, get very, don't know how to deal with the fear and the expenses of what's going to happen with their special needs child in the future. So do I need to make sure I'm referring to someone in their state? Is there, some things are covered under federal law, some people can work in several. I guess that's my question. As a lawyer, I can only work with people in New York. As a coach, or a mediator, I can work with people in different states. So does that make sense?
It's a bit of the same for an insurance agent, financial advisors. We are licensed and registered, licensed in different states. I'm licensed in about 15 states. I can sell insurance. I just have to get the insurance license of that state if that's needed. But here you have Ian, who is in your area, I would imagine, right? So I guess when you talk to these families, they need a financial plan. I mean, there's no question about it. They need to know how they're going to fund the future of their loved one with special needs while they are not, once they're passed. So the financial advisor would be the person to add to that team, and then devise a plan with the trust, where you have an estate attorney writing a trust, and then the financial advisor recommending policies to fund the trust at the passing of the caregivers. So do you need to work with someone from this particular states? Not really, but you do need to work with somebody who is licensed in that state. That's right. Ian, anything you would add?
Yeah, so basically pick a state, we pay the $100 and lo and behold, you're licensed. It's that easy. It's not like for attorneys where you need to get barred in the state. It's not,
No,
it's
we
not
just
onerous at all.
call and get $100 and we get a license. It's not
Yeah.
it's
Okay,
easy.
perfect.
Yeah.
Yeah.
Yeah,
Thank you.
it's super easy. Yeah.
Good question. Good question.
I think that one of the things that's also interesting is the number of questions around trust. Folks are running around between able, first party, third party. They just no clue on where money should be, and they're opening up accounts that should not be opened. People talking about able like it's the next thing, next to sliced bread. And unless your child is working or it's their money in some way, shape, or form, quite honestly, unless they're working, there's no reason to have an able account. There's just not. If you get a settlement, let's just say somebody else passes away in your family and they did crappy planning and they passed it directly to your child with special needs. And I have a client like this who got $500,000. So now the child has 500 grand in her name and she doesn't qualify for any benefits. She can't open an able account. That's not going to fix anything, but she needs to have a first party trust written. So her question to me is what do I do? How do I solve that? And so for us as professionals, because we work with 30 or 40 families, I work with 30 or 40 families, they're in this situation, it's very easy to say, this is the answer. But, I was like, who else have you spoken to? She's like, oh, I spoke to a few people. We didn't get past able. I'm like, oh, okay. So it becomes, so I think right to your point, Emily, in the very beginning, which is you're super excited to be in this group of professionals who have some idea of what's happening. So am I, right? Just super excited about that.
Yeah, very difficult to find, and everybody tries, right? But if you don't have the knowledge, and, we learn every day. It's not like we have it all there. It's we learn from each other. We learn every day. To Ian's point, I see that situation also, and the discussion to have with grandma and grandpa who have put the grandchild on the beneficiary on their policy. You gotta tell the families they need to reach out and talk to whomever they think will put their child as a beneficiary, because this is a big thing.
Well-intentioned family members can be a disaster area.
Oh yeah, you lose all your benefits. It's yeah, no.
It could be a year to get back on Medicaid. It's just, it can be a nightmare. And the DDD and the OPWDD, you know, in the Northeast are really big, and you need some very specific knowledge to navigate them. So the last thing we want to do is inadvertently have a family member knock us off something we worked so hard to get in the first place. Anyway, I want to say thank you for having us.
Yeah, thank you for that. That's an important topic, actually, and it's like I said before, a pretty complex one. So
I think this was so helpful for us personally and for our clients, and obviously for sending someone in the right direction, right? Obviously, they need an insurance agent who understands the complexities of a special needs young adult or adult, right? It's a different dynamic. And so for you to share your knowledge base and give us those visuals and really explain the differences for us, I think you're just great resources. So thank you for your time and for collaborating together on this. I really appreciate it.
You're welcome. Thank you for having us.
thank you. Yeah.
Thank you. This was so helpful. It was wonderful. Thank you. Really.
If there aren't any other questions, we'll just go through the rest